Hello to the hockey family. Welcome to another educational webinar. I'm Tyson Strachan, and as always, joined by my former college D partner, Johann Kroll. Today's topic that we are covering is when should an NHL player use a retirement compensation arrangement, typically known as RCAs. Like our other webinar topics, a very complex topic that there just simply was not very much good information out there. So Johan did our last newsletter covering the topic. Again, breaking down a very complex topic into something very easily understandable, and then wanted to follow it up with a nice webinar here. So
Yeah. And it's one of the, there's information out there. I think what just some of the players and like agents, it's just a lot of the information out there is quite technical and just kind of hard to understand. So we just thought it was worth spending a little bit of time and just kind of breaking it down into the RCA, just the most simplistic form, and showing some basic examples just to demonstrate how they can be helpful at times. And really a big part of RCAs and the benefits come in the potential tax savings, right? So it's no it's not a secret. Like, taxes are a concern for players playing up in Canada with Ontario, BC, and Quebec, right? I think top marginal rates, you're looking at 53.5% in change, somewhere around there. So losing over half your money in taxes is tough. And then you have Manitoba, Alberta, and Sask, not far behind those three provinces. So utilizing RCAs is certainly a strategy that we think any international player going into play, in Canada, it's worth considering. Just the pros, cons, and if it might make sense to create while you're in Canada. And then even aside from the potential tax savings, right? We'll touch on toward the end, but our RCAs can also act as a really helpful kind of forced savings mechanism for while players are in their peak earning years, their highest earning years. So we'll look at that as well. But a very important disclaimer. Through this webinar, Hockey Wealth Group does not render or offer to render personalized financial, tax, or legal advice. This webinar is educational, meant to be very, very educational. As Strax correctly pointed out in the opening there, RCAs are very complex. All right. So just the differences for different provinces that you're in, incredibly important that you're coordinating with proper professionals, proper attorneys, so CPAs. So again, this is 100% educational, just to help the hockey family better understand RCAs, and that this webinar certainly is not meant to be financial, tax, or legal advice. All right, Strax, kick us off.
Yeah. So goals for today. What is a retirement compensation arrangement, an RCA? Obviously, when does it make sense to create an RCA? How can a player potentially reduce their tax bill? How do you properly manage investments within the RCA once it's set up? And then at the end, what happens when you unwind the RCA?
Yeah. All right, let's do it.
Yeah. First thing, what is an RCA? It's a Canadian trust created through an addendum to the standard player contract. It's important to realize that the CBA does permit players to do this. Rather than having the full contract value paid out as salary, players can elect to defer a portion of their salary into the RCA trust.
Yeah. And so on this point, like, and this is where it's really important to lean on your legal team, your attorneys on this front. Like, uh, most of the attorneys we work with in Canada on these RCAs, they feel there's adequate like precedent and enough out there to justify deferring up to like 49% of the contract value into the RCA. But this is certainly a little bit of a gray area into like how much you can actually defer in the RCA. So definitely something to work with your legal team on, and the way you might structure that contract in amending the standard players contract.
And although it is a Canadian trust, it's important to know that the investment assets of the trust can be managed in the player's home country. So a great example, for a lot of our clients in the States, obviously, assets invested at Charles Schwab.
Yeah, and also, for like U.S. tax purposes, and we'll get into this in a little bit, but really these RCAs, again, from the U.S. perspective, they're treated as a grantor trust. So the U.S. tax authorities view the player as still like maintaining control and still owning those assets in the life of the RCA. And at the end of the day, like structured properly, and we touched on this at the beginning, but really like RCAs, that they serve two important goals, which is why you consider them to create significant tax savings, and then it can also be an exceptional force savings mechanism as well.
Yeah. When does it make sense to consider an RCA? Important point here. Players who do not intend to retire in Canada after hockey, players who grow up outside of Canada, but then sign a contract to play for an NHL team in Canada. Um, Also, coaches, GMs, other team personnel working in Canada may also be eligible.
Yeah, and just one thing I want to bring up here, again, RCA, so retirement compensation arrangement, and sometimes like retirement, the word retirement in that acronym can scare people. Just given a number of other tax deferred accounts, if you will. You might think that you can't touch these assets until age 59 and a half, or whatever it might be. Uh, for the purpose of RCAs, like the retirement, uh, really, it's just like a temporary structure. Okay, so and we'll get to when most players want to unwind these, but it's really just for only in your time in Canada. You want to use these, and then you actually have access to those assets immediately, like but basically the year after you're getting done in Canada. So don't let the word retirement in RCA make you think it's like illiquid for another 30, 40 years.
Okay, so the first thing we'll look at here is how taxes look like without having an RCA set up. So, using an example of just a 1 year contract, $6 million value.
Yeah, so unfortunately, this is yeah, unfortunately, quite straightforward. And so for the purpose of our hypothetical educational example here, we're going to use a top marginal tax rate of 53%. All right. Again, we mentioned at the top, like there are three provinces with hockey teams that have taxes north of 53%. There's also a handful that are less than 53%. So we're just going to, again, this is an oversimplification. Again, educational purposes only, just trying to create a simple scenario. So we're going to use 53% throughout the example here. But $6 million contract, there's no RCA in place. That entire $6 million is going to get taxed at 53%, which comes out to $3.18 million in taxes due. the player is going to walk away with 2.82 million at the end of the day. So kind of a tough pill to swallow to lose over half your money to taxes.
Yeah. And then second slide here, we're going to look at what an RCA looks like.
Okay, so same $6 million contract. Player B here is going to utilize an RCA. All right, so how this works, and I'm going to go through these pretty slow because the dynamics of these can be confusing, and even back when I was learning these a while ago, these are hard to understand. Okay, so again, we mentioned how most attorneys that we work with feel 49% is a safe amount to defer into the RCA. So that leaves us with 51% that does need to get paid as salary, right? So $6 million contract. This player is going to get paid 50. So they're going to, again, create that addendum to the standard players contract where they're going to be paid 51% of that contract. All right, so a little over $3 million paid as salary. All right, now the portion you receive as salary, this still obviously has to get taxed, right? So this is going to get taxed at our 53% top rate. So 53% of that 3 million and change is about 1.6 million that this player would pay in taxes. All right, now to the confusing part. The other 49 is going to go into the player's RCA trust. All right, so a little over 2.9 million, 49% of the contract deferred into the RCA trust. All right, now the way this works, and this is between the CRA and their rules with this, but basically money that gets funneled into the RCA trust, you need to split it into two separate buckets. Okay, so again, the 49% that's going into the RCA trust, it's split into two different buckets. Half of it, okay, is going to go into a non-interest bearing refundable, okay, that word's important as we work through this, a refundable tax account that the CRA is actually going to hold. Okay, the Canadian Revenue Agency is going to hold 1.47 million. All right, so half of the RCA, the CRA actually holds in a non-interest bearing refundable tax account. Right. The other 50% is moving this way into a regular investment account that's managed by the player's wealth management team, right? So a firm like ours at Hockey Wealth or any other advisor that you might be using. All right, so CRA, so the Canadian government holds 50%, and then you have 50% that can be invested in the RCA.
Next here, we'll have to look at an important distinction, how Canada and the US view RCA trusts. Obviously, very
Okay.
different.
Yeah, so this is critical. This is really critical. And let me start by saying, you'll notice this says Canada, US. Really, you want to look at any international arrangement as well, right? So if you're somewhere in Europe, wherever else, players coming into play in Canada, you're going to want to look at the way those taxing authorities view them as well. The reason we have Canada and US here, maybe not surprisingly, most of the players we help are going to fall Canada, US. So we thought this was the most relevant example. But the difference in the tax treatment between Canada and the US is exactly why this works. Okay, so starting on the Canada side, okay, so Canada views the RCA as a tax deferred vehicle. The US does not view the RCA as a tax deferred vehicle. Okay, so that should kind of like open your eyes, like, whoa. And of course, like a U.S. player that's playing in Canada is going to have a tax return on both sides, which we're going to get to. But to take this just a step further on the Canada side, right? So with an RCA, the amount deferred into the RCA, it's not taxed in the year it's contributed. All right, so it is not taxed in the year it's contributed. Rather, the RCA is taxed upon withdrawal. All right, and then importantly, and you see where this is going, but upon withdrawal, if you are a non-resident of Canada, there's a special 25% tax rate on the withdrawal for a non-resident of Canada. Okay. On the US side, again, because they do not view the RCA as a tax deferred vehicle, the entire value of the contract is considered taxable in the year it was earned. All right, so I've highlighted with colors like the parts that are really important. Okay, just the whole strategy is going to map out based on what I have in red and in blue. Okay, because again, the U.S. the entire contract, so the entire 6 million, considered taxable in the year it was earned, whereas in Canada, the RCA part not taxed in the year it's earned or contributed, but rather at withdrawal at a 25% rate for a non-resident of Canada. So this would be a good place to just press pause and really kind of wrap your head around this, because the way this all plays out is going to be based on this. And this next slide.
Yeah. Yeah, it's starting to get quite complex here. But so to understand it, you need to have a basic understanding of foreign tax credits and how they work in a situation.
Yeah, exactly. All right. So stated very simply, and again, I realize a lot of this is an oversimplification. I'm going to use that word a couple of times today, but just a basic understanding of foreign tax credits. So yeah, to help prevent the same income from being taxed twice, foreign tax credits allow a player to reduce their tax bill dollar for dollar for income taxes paid, that's already been paid in another country. Okay. So again, the purpose of our example here, from the perspective of a U.S. tax resident, a player's taxes due in the U.S. can be reduced by the taxes they're already paying in Canada and expect to pay in Canada, like future taxes as well. And you'll see why this is important as the RCA plays out and the differences between a U.S. and the Canadian tax return.
Yeah. And then here we're going to take a look at the projected tax return, what it looks like on that $6 million contract.
Yeah. Okay. So here again, like we outlined, $6 million contract, a player that's utilizing an RCA. I'm going to try to go through this really slowly, because I know this will look confusing, but this is just one you might need to watch like two or three times to fully grasp what's going on. All right. So let's start on the Canadian return over here for just a moment. All right. So again, tax rate, we're using 53% on the salary portion. This player, $6 million contract, like we went over, 51% is being paid as salary, 49% to the RCA. All right, so on the 51% paid as salary, a little over 3 million, we're going to owe some taxes. Okay, so 53% tax rate on a little over 3 million is going to come out to about 1.6 million that this player is going to pay taxes in Canada. Those are very real taxes that are being paid in the year that they are earned while they're playing hockey this year. Okay. Now on the U.S. return, okay. Now on the U.S. return, you're going to pay on the US tax return. Okay, we have the top federal rate in the US is 37% plus state. All right, and this is a real. We could probably host a whole webinar just on the importance of state residency for U.S. taxation. For the purpose of our example, okay, I'm going to assume 0 on state. Okay, just to make a point. So maybe the player establishes U.S. residence in Florida, maybe in Tennessee, something outside of Nashville, like a lot of guys do. Texas. There's a few other 0% U.S. state income tax states. So some of the CPAs that we work with on the hockey front, before a player goes to start, multi-year contract in Canada, not a bad idea to maybe purchase a home in Florida or in Nashville that you might live after hockey. Maybe get a driver's license, something like that. Knowing you're going to be there long term. So just that from a tax planning standpoint can help a lot, right? So because on your U.S. return, remember the U.S. is going to tax the whole 6 million. So top federal rate currently 37% in the U.S. It's a big difference from 53. So 37%, but plus whatever your state is. So if your state tax is 10%, you can imagine that's going to erode a lot of the potential tax savings here. All right. So with that in mind, I'm going to say the state tax is 0 in our example. So on the U.S. return, again, the RCA is not tax deferred. So the entire 6 million is taxed at 37% in the year of the contract. So the full 6 million. So 37% of 6 million. This player on the US tax return, it's going to say, hey, taxes this year are 2.22 million. All right. Now, does a player need to write a check for 2.22 million? No, because of the previous slide. This is where foreign tax credits come in, which was important. So we need to add back our foreign tax credits. So easy to start right here on the left. So what did we actually pay Canada this year, right? So of the $3 million, 3+ million that was paid in salary, we know that this player already paid 1.6 million in taxes. So we get to add over this foreign tax credit. So that's going to help reduce the tax bill. All right. And then the second step, and this is just, it's a little tricky, but just the way foreign tax credits work. Now, even though in Canada, like for this particular year, we're done with taxes on the Canadian side. All right. We still have this RCA that we know is going to become taxable in the future. All right. So hold this down. We know that if this player is going to be a non-resident of Canada at some point in the future, we know there's going to be a future 25% withdrawal tax on this RCA, right? So the whole RCA, this 2.9 million and change, 25% tax on that is 735,000. Now, we get to bring this over as well as a foreign tax credit because remember, from the US, from the IRS perspective, they want to tax this whole contract in the year it's earned, right? So although on the Canadian return, the RCA is not taxed at all, it's a tax deferred for now. We get to add back that foreign tax credit in this year on the US return. All right, so we add together these foreign tax credits, total foreign tax credit, 2.3 million. All right, so when we compare the total tax bill, right, in the US, given the earnings, which was 2.2 million, we have a foreign tax credit of 2.3 million, right? So given that the foreign tax credit exceeds the actual tax bill, this means we're going to have no U.S. tax bill due in the U.S. right? So the player does not need to write a check to the U.S. Now, we've got the question, do you get a $100,000 refund? The answer is no, right? So that's not a refundable tax credit. That it's going to end up being a carryover that you may or may not use in the future. Again, this is a huge oversimplification, but just like walking through the way this works. Okay. Strax, how many people did I lose on that slide?
Mm, a good portion. Probably watch it a couple
Okay.
more times. Yeah.
Yeah. Yeah. So and I remember like when we first started learning about these for players, it was like I had to go through it multiple times. Like it just,
Yeah.
the Canadian return, the US return, going back to the slide, like when, when are things deemed taxable, the different rates, state taxes, how they matter. It's just that there's a lot of moving parts here. I promise if you watch this 2 or 3 times, it'll start to make sense.
And also highlights the importance of using a good CPA, right? That understands these
Uh,
things.
and attorney
Yeah.
to
And
draft the
attorneys.
RCA and the
Yeah.
administration of the RCA. Yep.
Yeah. Absolutely. Okay. So now that people have watched that multiple times, we'll move on and talk about what it looks like, during the life of the RCA.
Okay, so 2 important points to remember in terms of the management of the RCA. Okay, so one, remember that like the RCA trusts, it's made up of both the investment bucket, but also that refundable tax account with the CRA, right? So it's really easy for players to like forget this half over here that the CRA is holding temporarily. Like that's still a part of the overall. That's a part of the trust itself. Okay, and then like we've been over a couple times, like the IRS, it does not recognize the RCA as a tax deferred vehicle. So why that's important to remember, even during the life of the RCA, couple important implications for the way you manage these. All right. So number one, the investment portion, right? So that 50% should be managed very tax efficiently, right? With great tax efficiency in mind. Because if the investment side is being turned over a bunch, realizing capital gains, uh, that's going to drive up the U.S. tax return, right? Like you might eat away that whole credit that you might end up paying a tax on the U.S. side. Um, you can add to that the tax bill on the U.S. side if you're not careful, because the U.S. isn't recognizing the RCA as a tax deferred vehicle. It's really, you can think of it more of like just a regular brokerage account, like a regular non-qualified investment account. Also on this point, investments in the RCA should be very liquid. Okay, so no alternative investments, no complex life insurance policies, no real estate, no art, right? Just very very liquid investments that are easy to unwind when the time comes. Right. The second implication for RCA management, and this ties to just remembering that. Um, the bucket the CRA is holding, the 50% in the refundable tax account. Remember that, like, that's a part of the RCA trust. So when you look at it big picture, one way I just like to look at it is that 50%. Like again, that's not investment. It's not invested. So it's largely acting as a fixed asset. This side that the CRA is holding, right? It's not going to grow. It's not going to depreciate. It's not going to decrease in value, other than it maybe inflation, but not to get that's aside. But so it's, you can think of it as a fixed asset, meaning the investment side, the part you do have control over investing, and this is where it's all going to depend on the players. situation and circumstances. But for a lot of players, younger players in particular, there's probably a pretty strong case that this investment portion should be 100% equities. Okay, couple reasons for this. The one is if just this one side that you have control over is 100% equities in aggregate, right? When you include the 50% that's not equities at all, like in aggregate, you're basically just setting up a pretty moderate 50-50 portfolio, right? Like RCA trust, 50% equities, then you have 50% fixed that the CRA is holding. The other incentive to hold equities on the investment side is again, it ties back into just the tax efficiency. Many of you know that in the US, just like the qualified, the tax treatment of qualified dividends, right? The qualified dividends are going to get taxed more like long-term capital gains. So in the higher tax brackets, you're at, it ends up being like a 23.8% tax on those dividends, or 20% plus the 3.8 net investment income tax. So 23% tax on qualified dividends. Whereas if you start to introduce like fixed income, like bonds, much of that, unless you're in municipal, much of that's going to be taxed at ordinary income rates, right? Which that gets pushed more in the 37%. So, yep. So tax efficient, low turnover, and yes, strong case to be made that the investment portion should be somewhat aggressive to create an aggregate 50-50 portfolio.
And next, Yogi, can take a second to kind of talk about when it makes sense to unwind the RCA and what that looks like.
Yeah, unwinding the RCA. So ideally, not until both of these conditions are met. Employment with your Canadian team ends, and you're no longer a Canadian resident. If we unwind prior to leaving Canada, that will largely defeat the whole purpose of the RCA, because that 25% non-resident withholding tax, that you don't get that treatment. If you unwind while you're in Canada, they're going to tax it at your top rate. So it could end up getting taxed at 53%, and it kind of defeats the whole purpose. So one question that we receive from time to time, like, hey, what if I sign with a new Canadian team on another contract, right? Well, in that case, a second RCA should be considered, analyzed if it might make sense to create a second RCA. You cannot merge RCAs, so you can't just add on the second team into roll over, consolidate, if you will. You can't do that with RCAs. Okay, so going back to our example, the way this would all play out. All right, so once the player has returned home, and again, in our example, we're using a U.S. player. So what you do, you're going to add up the total value of the RCA, right? So you're going to calculate. So you're going to combine both the value of the CRA, the refundable tax account, and the investment account, right? So just to keep our example super simple, we're going to assume just a 0% growth. Market didn't do anything, net of the costs, which we'll get to, of creating an RCA. Let's just say zero growth. So we're just going to add the two buckets. The RCA, again, in this case, let's say it's still worth 2.94 million. All right. Now, assuming at this point we're a non-resident of Canada, Canada is now going to apply their tax on the RCA. So a flat 25% non-resident withholding tax, that's going to come out to $735,000. All right. And then the remaining 75% is distributed to the player. Right? So 2.2 million and change distributed out to the player. So Canada's happy. Yeah, so they got their RCA tax on this piece. Remember, so Canada got paid taxes on the salary when it was earned. That was the 53%. Now they're getting paid on the other part, on the RCA part. A question we get a lot, like, so this 2.2 million, does this get taxed? And the answer is no, because now think back to the US side of the return. Remember, from the US perspective, this entire contract value was already taxed in the year it was earned. The whole contract was taxed. All the earnings were taxed in the year it was earned. And so therefore this withdrawal, this 75% distributed to the player, this is simply just a return of capital. It's just a return of capital. It's a tax-free withdrawal out of the trust and just into the player's individual name. So no tax on the U.S. return, no tax on the unwinding of the RCA.
Next really important piece would be just comparing, a tax comparison of not having the RCA and having the RCA.
Yeah. All right. Again, no RCA. We did this example at the beginning. 6 million taxed. We're using a 53% tax rate. 3.18 million in taxes paid. On the RCA side, 49% in the RCA trust, 51% paid as salary, right? We know, so the part paid as salary, we're paying taxes on that right away, 1.6 million. And then we're going to end up paying, 25% on the other side here, 735,000 tax paid. So we add these two together. Total tax paid with the RCA in our hypothetical oversimplified example, I can't state that enough, 2.3 million in total tax paid with the RCA. Just in comparison, right, this ends up being roughly an $800,000 tax savings. Importantly, in 1 year. The purpose of our example here, like, we're just assuming a 1 year, $6 million contract. Imagine if this is a 6x6. Yeah, a 5-year, 6-year, 7-year contract, right? Like, you can begin to quantify how important these can be, how beneficial they can be when used in the right situation. And again, while this webinar has largely been around the potential tax savings when these are executed correctly, really, really important to also understand, just aside from the potential tax benefits, just how important these RCAs can serve as a built-in forced savings mechanism during a player's peak earning years.
And as we all know, the business side of hockey, can be shrewd and unpredictable.
Mm-hmm.
I say it a lot. There's a very tiny percent of players that kind of get to end their careers on their own terms. So, um, you know, outside of just like you said, the tax savings piece of it, kind of forcing that mechanism of putting savings aside for later, can really help kind of long-term success.
Okay, so why would a player not do an RCA? So want to kind of walk through the main downside of RCAs. So a very practical thing is cost. As you can probably imagine, RCAs, setting them up are not free, right? So you're going to want to work with a Canadian attorney that has experience in creating these. And so creating the trust is going to cost money. Uh, the administration of the trust is going to cost money. It's an extra trust tax return that will need to get filed each year. Like that's going to cost money. Um, and so it's one of those things like if you're an entry level guy, an entry level contract where you might be up a few games, then back in the American League, up and down, like the cost of those things can outweigh the benefits. Okay, so it's just something that you need to look at. Um, but gosh, like if you're on a one-way NHL deal in Canada, you can start charting out the math, and in most cases, um, if you're on a one-way NHL deal, particularly if you're in a multi-year one-way NHL deal, uh, a player is going to want to give a really good hard look at uh, that benefit analysis, and if paying for the attorneys to set up the trust and administer the trust and the CPAs to file another tax return, if that's in your best interest, and um, many times we've found it is. So it's something for each player to kind of take a look at.
Yeah.
That was a lot of information, and again, can't state it enough that really really important to work with your legal professionals, your CPAs, um, to take a good hard look and get good professional advice from them as the way things might stack up in whatever province you might be playing in, and just how that looks with your overall situation. But our team, of course, would love to be a resource for you and your family. If you have questions on this, our team's happy to coordinate and put you in touch with those professionals that attorneys, accountants that have experience doing these for many players that have already done them, are currently doing them. So yeah, we'd love to be a resource. So feel free to reach out at any time. And what I forget, Strax, that was a lot. Hopefully not. I tried to
I
break it
don't.
down the best I could.
Yeah. I think you did a wonderful job. Yeah. I didn't help you out very much. There was a lot on you, but no, I think it's a super valuable thing to walk through. And I think you mentioned it multiple times. This is obviously a simplified version. It's still complex, and hopefully people will take the time, kind of rewind a few times, maybe get a pen and paper out and scratch through it. But
Yeah,
um, worth understanding and worth looking at. So.
yeah, awesome. Well, we'll talk to you guys soon. Appreciate it.